Welcome back to the GIST English Masterclass. Today's explainer is going to guide you through the absolutely vital vocabulary of finance, basically giving you total confidence in literally any economic conversation. Whether you're just trying to manage your own daily budget at home or you're stepping into a massive corporate boardroom, understanding precise financial terminology is just absolutely essential for clear communication. By the time we wrap this up, you won't just memorize the words, you're going to actually understand the core concepts behind them. So let's jump right in. Here is a quick look at the agenda for our explainer today. 1. Core money concepts. 2. Banking and transactions. 3. Payroll and deductions. 4. Professional office expressions. And finally, 5. Loans and advanced finance. All right, Section 1, Core money concepts, understanding your foundation. Think of your entire financial world as a giant scale that constantly needs balancing. On one side, you've got the money coming in. These are your assets, which are the resources you literally already own, like cash or property. And then you have your revenue, which is the fresh income you generate from working or selling things. Now, you always want to measure those positive forces against what's going out. Those are your liabilities, representing your ongoing financial obligations like debts. And of course, your expenditure, which is really just a formal, fancy term for your daily expenses. You know, like buying groceries or filling up your car with gas. Moving right along to Section 2, Banking and transactions, moving your money. So consider the basic life cycle of your money. You know the drill when you step up to an ATM to handle your cash. You're typically doing one of a few key actions. First, you might make a deposit, safely tucking your hard-earned money right into your account. Later on, you might initiate a transfer, actively moving that money between, say, your checking and savings. And finally, when you actually need cash for the weekend, you'll see a debit pop up on your screen, resulting in a withdrawal, which is the physical act of taking that cash right out of the machine. Now what happens when you need to send that money to someone else? There's a really crucial distinction here. If you just need to pay a friend back for dinner or settle a quick local bill, a standard bank transfer via the domestic banking system works perfectly well. But if you're doing something huge, like buying a house or sending money overseas, you're going to need a wire transfer. That's a super fast, highly secure electronic transfer specifically designed for high-value or international transactions. But a quick heads up, moving money around isn't always free. You've got to watch out for the cost of transfer, which is sometimes just abbreviated as COT. This fee should always be considered before processing your payment. Seriously, there is nothing worse than surprise fees draining your account just because you didn't read the fine print before clicking send. And speaking of draining your account, if you aren't super careful with automatic direct debit payments for all those monthly subscriptions, or if you just lose track of your spending on your linked bank card, you might accidentally hit a negative account balance. In the banking world, this is called an overdraft. And trust me, it comes with some hefty penalty fees. When that happens, you might even be forced into a tight spot where you have to borrow money using a credit card just to cover the gap. Definitely something we want to avoid. Let's jump to Section 3, Payroll and Deductions, getting paid. Okay, let's look at the payroll. This is a classic point of confusion for a lot of young professionals. Let me ask you, do you actually know the real difference between your gross and net pay? Well, if you're following the explanation, then click the like button, and let's solve the total mystery of your shrinking paycheck together right now. Here's the deal. When you negotiate a salary at a new job, you are negotiating your gross pay. It looks incredibly impressive on paper, right? Because it represents the total amount before any deductions are taken out. But your net pay is the smaller, final amount after taxes, health insurance, and retirement contributions are all pulled out. This net amount is what actually hits your bank account. It's what you actually get to take home and use for your daily expenses. Next up, Section 4, Professional Office Expressions, sounding like a pro. So imagine it's 4 p.m. on a Friday, and your manager walks in and asks you to crunch the numbers. Don't panic, they don't mean anything physical. They are simply asking you to sit down, open up your spreadsheets, and thoroughly analyze the financial data to spot trends, solve a problem, or balance a budget. It's a super common phrase you'll hear all the time. Now, what if you're actively trying to crunch the numbers, but you just don't have the exact data in front of you yet? Well, that is exactly when you provide what we call a ballpark figure or a rough estimate. These terms basically mean you're giving a highly educated guess. It's an approximate number or a general calculation that helps keep the whole business conversation moving forward while you wait for the concrete details. However, there is one financial phrase you never, ever want to be associated with. You absolutely want to avoid any company or colleague that decides to cook the books. This is a highly dangerous phrase, meaning to manipulate financial data illegally, usually to hide massive losses or fake profits. Seriously, if a manager ever asks you to cook the books, it is literally time to pack up your desk and find a new job. And that brings us to our final module, Section 5, Loans and Advanced Finance, the Big Picture. Let's step away from the daily office grind and look at some major life milestones. Taking out a general loan simply means you are using borrowed money. Pretty straightforward. But securing a mortgage means you have a specific, massive type of loan used exclusively to buy a property. And remember, that borrowed money isn't free. If you can't pay the interest, which is literally the added cost of borrowing that money over time, you risk the absolutely devastating event of foreclosure, which is where the bank legally steps in and takes the property back. Now, zooming way out to an international scale, we encounter the forex market. This is the massive global currency trading market, and it is entirely driven by the fluctuating exchange rate, which is simply the value of one currency measured against another. So, whether you are executing a wire transfer overseas or honestly just converting some cash for a summer vacation in Europe, the forex market is the invisible force at play behind the scenes. Finally, we absolutely must talk about the sunk cost fallacy. This is an incredibly common psychological trap in advanced finance. It happens when you stubbornly continue a bad strategy or keep pouring money into a failing project simply because of the past investment you've already made. Think of it like continuing to repair an old, totally broken down car just because you already spent $1,000 on it last month, rather than looking objectively at the fact that it has zero future potential. We've all been there. So, I want to leave you with this provocative thought today. Are you currently holding on to a bad financial decision in your own life purely because of the sunk cost fallacy? Take a moment to reflect on your own financial habits to ensure you aren't falling into these sneaky mental traps. Keep practicing this vital lexicon and see you in the next class.